Hi, I'm Lena Rao. Welcome to our Ask a VC show where we put VCs in the hot seat. This week we have Mike Hirshland, founder of Resolute Ventures. Welcome, Mike.
Thanks, Lena. It's great to be here.
Great to have you. So I'm going to go into your bio just for a little bit. You founded Resolute Ventures as a seed stage VC fund in 2011. Your portfolio companies include MessageMe, Bark, which you've given a shout out to on your lovely T-shirt. Bidium, Car.com, HomeJoy, among others. And actually, prior to Resolute, you were an early stage investor at Polaris and led investments in Automatic, creator of WordPress, Q1 Labs, 6wave, Lowell Apps, Kissmetrics, many others. And you also conceived and led the San Francisco launch of Dogpatch Labs. So lots of experience with seed stage investing. One thing I wanted to talk to you about is party rounds. It seems like there's always conversation from investors about how much they hate them. But the conversation has been more recently ignited, by a number of investors. What, you've said, when you were even launching Resolute that you don't like headless seed rounds that lack a lead investor. So, why do startups still do them? Why do entrepreneurs still have, one recent startup had 50 investors. I mean, it's crazy.
Yeah. Well, I think sometimes it's an easier way to go. The dynamics in so-called party rounds often are that some well-known and high-profile angel invests and commits, and maybe it's a friend of the founder, or for one reason or another. It's usually not on the basis of extensive thought and analysis or diligence. And then what ends up happening very quickly is a whole bunch of other people say, well, if such and such invested, it must be good. And so you have this dynamic where it's almost like a card game or a shell game. And no one's actually really spent time thinking about, is this a good opportunity? And so in those instances, the deal can get done very quickly. And people are less sensitive to terms and things like that. So it can be sometimes an easier way of raising a round. And the other obvious attraction to founders, I think, is when you do get high-profile angels, it helps the prestige of your company, and people like having well-regarded people associated with their company. So I think that's why.
So entrepreneurs kind of fall into the trap for those two reasons.
Yeah, sometimes it's a little bit hard to resist when XYZ, the founder of some very successful company.
Yes, we can insert a lot of names into that.
Exactly. Now, I think the downside, though, is no one's really accountable. There's nobody who's waking up in the morning, and on their list of worries is how's company X doing? What are the key things that they need to be achieving? What are the problems they're facing? What's the help that they need, and are they getting it? Everyone in the party round situations, you end up having, much like along the investment timeline, people are assuming, well, someone's paying attention, so I don't really need to. And then when something goes wrong, and people start the buzz starts and people start checking in, it turns out nobody was really paying attention. And I think that the founder is really doing a disservice to him or herself, because there's nobody who really is saying, this is one of my primary responsibilities.
Right. I mean, you've been doing this, you've been doing seed investing for quite some time now.
I had hair when I started.
Have you seen this actually happen where, someone, an entrepreneur has 15 or so investors in their seed round, doesn't have a lead, and, things kind of fall apart? You don't have to name names, but, does it happen? It does happen.
It happens, I guess I would say, I would say it probably happens with more regularity than it does just the normal course. A lot of startups, things fall apart because that's the nature of the beast.
That's right, yeah.
But I think party rounds are probably more prone to things going wrong because either just because the deal got done not on the basis of it actually being a good deal, or because there were points along the way where if one or two investors were really engaged, maybe they could have pointed out, hey, here's a big issue you have looming. Have you thought about this? Or we can help you in this way. Have you thought about X, Y, or Z?
Right.
And so I typically throughout my career investing, I've been a lead or co-lead investor. But particularly in the very early stage of Resolute, I did do some investments where I wasn't a lead. And there's one in particular that was actually somewhat of a party round. And things didn't fall apart, but it became clear that things weren't on track the way they needed to be. And what I found was that every investor was really very passive. It's kind of like, yeah, well, let's see what happens. And at that point, I decided that there really was a great opportunity, but there's a very discrete thing the company needed to accomplish. And so I kind of spent some time with the founder and said, well, I actually would be interested in being your lead investor, but if you agree with me that this is the direction we need to go, that we work together to accomplish this thing, I'll step up and be your lead investor. And since then, I've become very active, and I'm excited about it.
Great. Well, I want to move on to one of our reader questions that was sent in. In simplest terms, how do you determine the valuation of a seed company you want to invest in? What are the factors that go into that, especially at such an early stage where there's no revenue, no users, just an idea and an entrepreneur?
So I think you have to appreciate that it's not a formula. And to say it was anything approaching mathematical or scientific would be really misunderstanding. It's a trade-off between an investor's desire for ownership and a founder's desire to minimize dilution. And I think at various points in time, conventions arise around what is the norm for what investor ownership levels are. And I think today, certainly how I think about it is my goal is to own 10% of a company through the seed round. And so depending on what the company has or hasn't accomplished, the track record and strength and visibility of the founder, and then there's the amount of interest in the deal. It's a multivariate combination where sometimes I think I really want the valuation to be, call it 4 pre.
Right.
And for me, 4 pre, 5 post, $500,000 check. That's like right in the middle of the formula. But it's a successful founder. Lots of people want to invest, and I know that other investors are going to be willing to invest at a 6 pre or 7 pre.
Are you looking at things like market size when you're
I think the short answer is no.
Okay.
For me, the analysis at the seed stage is a fairly succinct one. I think you either believe you've got a really strong founding team going after a real problem in something that broadly defined is a very large market. I don't believe in trying to zone in on exactly the product they're talking about and exactly the market size for that product, because it's going to change. The one thing that you can be certain about is at the end of the seed stage, it's going to look a lot of different than what you were pitched at the beginning.
Right.
So I think it's a waste of time to get too wrapped up. You need to believe that at a high level. Fast forward the company 3 or 4 years, they've made a couple pivots, they've changed things as needed. It can be a very large outcome, but that's not exactly market size analysis.
Right. Switching gears a little bit to another reader question about boards, and we get this question a lot. I think entrepreneurs are really concerned about how they structure their boards, but this one was about how does the board meeting itself look like?
Yeah.
And I'm curious what your perspective is on that.
So I have a pretty strong view on this, and it's probably not the typical one, but I'm not a big fan of boards during the seed stage. So I spent 12 years as a venture capitalist, and I think in many ways venture capitalists see their job as being board members and therefore going to board meetings. And my experience was that board meetings typically are pretty inefficient uses of time, and the larger they get, the worse it gets. So I really think at the seed stage there's very little need for the formality, structure, and process of board meetings as such, and I much prefer typically one seat for the lead investor, 2 seats for common, and no need for real board meetings. But there's interactions sometimes on a daily basis, sometimes on a monthly basis, and then I think a routine around check-ins, just to kind of step back a little bit and say, are we making progress?
How often do you check in on your startups?
So I think monthly check-ins on let's look at where we think we need to go and where we should be now. It's probably the normal rhythm, with lots of instances where companies at particular phases, there's a lot more interaction than that in between the monthly check-ins. it can be around a whole bunch of different things: hiring, certainly fundraising.
Do entrepreneurs, do they want more involvement at the seed level, or do you see that they want less involvement? How have you seen the founder go in this?
Yeah, so it varies considerably on the experience of the founder. I think there are some first-time founders who want a fair amount of interaction. But by and large, my sense is that there are some discrete areas where an investor can and should be really helpful around recruiting, certainly around financing, and then a bunch of just kind of soundboard-like feedback. But fundamentally, what the founder needs the most is time to build the product. And you can help the founder by having really strong other founders give input and give reactions. But I try, and particularly when the company's in crunch mode and really trying to get focused on the next release, to have as little unnecessary interaction as possible. So during the seed stage, I think companies go through spurts.
Yeah.
But there's a big spurt
That's right.
there where it's very product focused. And I don't think a lot of investor overhead is helpful.
Well, Mike, thanks so much for joining us.
Well, it's been a blast. Thank you.